macro currency signals.
Something extraordinary just happened. And the danger is not that it happened. The danger is that you're getting used to it. In another era, what we are witnessing right now in silver would have triggered emergency meetings, front-page headlines, and public reassurances. Today, it barely produces a shrug. Price collapses by historic magnitude. Billions in paper wealth evaporate in hours. Futures markets convulse. And by the next morning, the narrative is already moving on. That normalization is the real story. Because when structural breaks begin to occur this frequently, the public stops recognizing them for what they are. Not volatility, not noise, not routine correction, but irreversible shifts in the global financial order. And the silver crash you just witnessed was not a failure of demand. It was not the end of a cycle. It was not proof that the metal is weak. It was a transfer from weak hands to strong hands. From leveraged paper to unleveraged balance sheets. From traders to accumulators. From visible panic to invisible positioning. While you were watching the red candles, someone else was watching inventory. While retail traders were staring at collapsing charts, institutions were staring at ounces. And while headlines screamed crash, tens of millions of ounces quietly migrated into vaults. That is not speculation. That is arithmetic. Because here's what they don't tell you about modern markets. Price is not discovery anymore. Price is pressure. It is a mechanism. It is a tool. And sometimes it is a weapon. When leverage builds too fast, it creates fragility. When momentum goes vertical, liquidity thins. When positioning becomes crowded, gravity doesn't need permission. It simply waits. Silver had gone vertical. The move was parabolic. And parabolic moves are not sustained by fundamentals alone. They are sustained by leverage, layered on leverage, layered on leverage. Futures contracts, leveraged exchange-traded products, margin accounts, derivative overlays. It is a house built on borrowed conviction. And when that structure experiences even a modest shock, a shift in rate expectations, a spike in the dollar, a margin increase, it doesn't bend, it snaps. The crash was not a referendum on silver's importance. It was a purge of overstretched positioning. But what happened next is what matters. Because after the largest one-day drop in silver history, something almost no one is talking about occurred behind the scenes. Shares in the largest silver-backed exchange product exploded higher. Tens of millions of new shares were created immediately after the collapse, which means something very simple. Metal was delivered. Not promises, not exposure, not options. Physical silver. And here's the rule that most people don't understand. New shares in those vehicles are not created out of thin air. Authorized participants must deliver metal first. So when price is smashed, and within hours, massive quantities of new shares appear, that tells you exactly what happened. Someone with access to size, someone with access to capital, someone with access to the plumbing of the system, used the panic to source physical silver at distressed prices, and parked it. That is not retail behavior. That is not emotional buying. That is strategic accumulation. Price fell, metal moved, ownership changed. And this happened against a backdrop that is far more significant than a single trading session. Because globally, inventories have been thinning. Registered stocks in Western exchanges have been under pressure. Delivery obligations have been heavy. Refining capacity has been constrained. Energy costs have been volatile. And in the East, premiums have widened. Let's talk about that for a moment. There is a persistent and measurable difference between silver prices in Western markets and prices in Asian markets. Even after accounting for taxes, logistics, and capital controls, the spread has been significant. That spread is not theoretical. It represents physical demand that is willing to pay more for real metal. Not synthetic exposure, not paper claims, not ledger entries, metal. And when arbitrage opportunities become large enough, they create pull, physical pull. Metal does not care about your narrative. It flows toward the highest bid. If the East consistently bids higher, metal will move east. And when metal leaves Western vaults, paper claims do not magically become heavier. They become more fragile. Now step back and widen the lens. Why would physical demand be accelerating globally at the same time price is being violently smashed in paper markets? Because price and reality have diverged before. Because leverage and scarcity do not operate on the same clock. Because paper markets clear in hours. Physical shortages reveal themselves over months. The crash was fast. The tightening is slow. But slow tightening is far more powerful. There is another layer here that almost no one is discussing openly. Governments are repositioning. Critical minerals are no longer niche commodities buried in obscure reports. They are national security priorities. The language has shifted. Stockpiles, reserves, strategic independence, supply chain resilience. Those words are not used casually. They are used when vulnerability has been identified. For decades, energy security was the axis of geopolitical power. Oil-shaped alliances, oil-shaped currencies, oil-shaped war and peace. Now the axis is shifting. Modern economies run on metals. Electrification requires them. Military systems require them. Semiconductors require them. Energy infrastructure requires them. Digital infrastructure requires them. And unlike oil, many of these metals are geographically concentrated. Processing capacity is concentrated. Mining output is concentrated. Refining expertise is concentrated. That concentration creates leverage. When leverage is recognized, governments respond. Reserves are built. Financing is arranged. Domestic production is incentivized. Supply chains are reshored. And here is where silver sits in a uniquely powerful position. It is monetary. It is industrial. It is strategic. It participates in the monetary system as a historical store of value. It participates in industry as a critical input in electronics, solar technology, and advanced systems. It participates in geopolitics as a constrained resource with tightening supply. So when price collapses violently in a single session, you must ask a different question. Who benefits? Not emotionally, not rhetorically, mechanically. Who benefits from flushing out leveraged longs? Short sellers who want to cover lower, institutions who want inventory cheaper, participants who require physical metal and prefer not to chase vertical price. And who suffers? Over-leveraged traders, speculators using borrowed money, those who mistook momentum for inevitability. This is not morality, this is structure. Markets built on derivatives must periodically cleanse themselves. Margin requirements rise. Liquidations cascade. Weak hands are forced to sell at the worst possible moment. It is brutal, but it is predictable. And here is the key point. None of that changes the underlying supply-demand reality. If anything, it clarifies it. Because once leverage is wiped out, what remains is cleaner ownership, cleaner positioning, stronger hands, lower systemic fragility in that specific layer. The crash did not destroy silver. It destroyed excessive leverage. And now the market stands in a very different posture. Paper has been purged. Physical has been absorbed. Spreads remain wide. Refining capacity remains constrained. Global demand remains intact. And something else is happening quietly in parallel. Trust in paper claims is eroding. Every violent dislocation reinforces a lesson. If you do not hold it, you do not control it. If your exposure depends on a counterparty, you inherit their risk. If your ownership exists only as a line item, you rely on system integrity. In calm markets, that distinction feels academic. In stressed markets, it becomes survival. The crash reminded participants of that distinction. Because when volatility explodes, settlement systems strain. When margin calls hit, liquidity evaporates. When red numbers dominate screens, confidence thins. And in that environment, the difference between physical ownership and synthetic exposure becomes painfully clear. Now let's confront the narrative head-on. Many will say this was proof that silver was overhyped, that the rally was unsustainable, that the crash confirms weakness. But parabolic corrections are not signs of terminal weakness. They are features of commodity cycles driven by leverage. The fundamentals that drove the rally did not disappear in a single afternoon. Industrial demand did not vanish. Mine supply did not surge. Energy costs did not collapse. Geopolitical tensions did not resolve. What vanished was excess speculation. And that is a very different thing. There is also a psychological dimension to this. When price goes vertical, latecomers feel panic of missing out. When price collapses, they feel panic of being wrong. Both emotions are powerful. Both are exploitable. The system feeds on emotional liquidity. Buy high, sell low, repeat. But the participants who accumulated tens of millions of ounces after the crash were not operating emotionally. They were operating strategically. They were using price weakness as an acquisition tool. They were converting volatility into inventory. And inventory is power. Because in a world where supply chains are weaponized and materials are strategic, the party holding physical stock has leverage. This is no longer about short-term charts. It is about positioning within a changing global architecture. The old architecture was built on abundant liquidity, expanding globalization, and faith in paper systems. The emerging architecture is constrained, regionalized, and increasingly focused on tangible inputs: energy, food, metals. When constraints tighten, price signals become more violent, because thin inventories amplify shocks, because concentrated production amplifies geopolitical risk, because leveraged financial overlays amplify every move. You just witnessed that amplification. But amplification works both ways. The same structure that can drive price down 20% in a session can drive it up violently when physical demand overwhelms available supply. And here is the uncomfortable reality for anyone still dismissing this move as random. Physical silver in parts of the world is already pricing differently. The spread between East and West is not imaginary, it is measurable. And when spreads persist, they attract action. Arbitrage, reallocation, shipping, refining adjustments. But those processes take time. Paper markets react in milliseconds. Physical markets move in weeks and months. The crash was instantaneous. The tightening will be gradual. But gradual tightening, backed by structural demand, is far more consequential than a single day's collapse. There is another dimension to this that must be addressed: currency confidence. For decades, global trade has been lubricated by a dominant reserve currency. That dominance allowed deficits to expand. It allowed liquidity to be exported. It allowed financialization to flourish. But reserve status is not immortal. It is maintained by trust, by stability, by deep markets, by rule of law, by strategic leverage. And when strategic resources begin to shift geographically, when processing capacity becomes concentrated elsewhere, when physical materials underpinning modern economies sit outside your immediate control, vulnerabilities appear. Responses follow. Reserves are built. Domestic capacity is funded. Strategic rhetoric intensifies. You are witnessing that response. And silver, sitting at the intersection of monetary history and industrial necessity, is not peripheral to that story. It is central. So when you see a crash, do not isolate it from the broader context. Ask instead, is this collapse occurring in a world of abundance or constraint? Is this liquidation happening amid strengthening or weakening fundamentals? Are institutions reducing exposure or increasing physical holdings? The answers matter. Because markets do not confess during rallies. They confess after violence. And the confession this time was clear. After the largest one-day drop in history, metal flowed into institutional vaults. That is not fear. That is preparation. The question is, preparation for what? For tighter supply? For sustained demand? For geopolitical friction? For currency realignment? Perhaps all of the above. Part 1 ends here, but understand this. The crash was not the story. It was the doorway. Now step beyond the crash and look at what is tightening beneath the surface. Because while paper markets were purging leverage in hours, the physical world did not reset. Refining capacity has been strained. Energy costs remain volatile. Ore grades are not magically improving. Permitting new mines still takes years, not weeks. And industrial demand is not discretionary anymore. It is embedded. Silver is no longer just a precious metal sitting in vaults. It is wired into solar grids, electric infrastructure, advanced electronics, defense systems, and next-generation manufacturing. Every expansion of electrification pulls more ounces into permanent use. Every push toward energy transition increases baseline demand. That demand does not unwind because traders were liquidated. It keeps running. Now combine that with widening international price spreads. When one region consistently pays more for physical metal than another, it creates incentive. Arbitrage begins quietly. Shipments move, inventory drains from the lower price market toward the higher bid. At first, the shift is subtle. A few million ounces here, a few million there. But when vault inventories are already thin, a few million is not trivial. It compounds. It tightens availability. It reduces buffers. And in a market built on fractional claims, reduced buffers increase fragility. This is where the real tension builds. Paper silver can expand infinitely. Contracts can be written. Exposure can be created. Synthetic supply has no geological limit. Physical silver does. It must be mined. It must be refined. It must be transported. It must be delivered. And if refining capacity contracts while demand expands, the bottleneck becomes visible. You cannot print throughput. You cannot digitally manufacture ounces. You cannot margin call a mine into producing faster. So ask yourself what happens when leveraged paper positioning has already been flushed, when institutional holders have quietly accumulated on weakness, and when physical demand begins to accelerate again. There is less speculative froth now, less unstable leverage, fewer weak hands. What remains is stronger ownership and tighter supply. And that changes the character of the next move. Because the next advance, when it comes, will not be fueled primarily by momentum traders chasing green candles. It will be fueled by structural buyers who require metal for strategic reasons, industrial, monetary, or geopolitical. The crash cleared the runway. It did not cancel the flight. There is also a psychological shift underway. The public just watched a violent correction. Many will step back. Many will hesitate. Many will tell themselves it was a warning. But institutions often prefer hesitation in the crowd. Lower noise, lower competition, better entry points. By the time confidence returns loudly, positioning is already done. And here is the deeper layer. We are moving into an era where tangible assets are being repriced relative to financial claims. Decades of expansion in debt and derivatives created the illusion that paper could substitute for substance indefinitely. But supply chains fractured, energy systems strained, geopolitical lines hardened. Suddenly, control of materials matters more than theoretical liquidity. In that environment, metals are not optional exposures. They are strategic anchors. Silver's dual identity, monetary memory and industrial necessity, gives it a role that is difficult to replace. And replacement is the critical word. There is no easy substitute for silver's conductivity at scale. No simple alternative for its role in certain high-efficiency systems. No digital workaround for atoms. So when price is forced down by leverage mechanics, but underlying demand remains intact, you are witnessing divergence. Divergences do not last forever. They resolve. Either demand collapses to justify price weakness, or price eventually rises to reflect demand. So far, there is little evidence of collapsing structural demand. What we saw was financial pressure, not industrial retreat. And that distinction will matter more as time passes. Because once inventories tighten further and physical premiums widen again, the narrative will shift quickly. The same voices that called the crash a warning will call the rebound a surprise. It will not be a surprise. It will be the consequence of what is being built quietly right now. Stronger hands, tighter supply, strategic accumulation, and thinning buffers. The real reason for the silver crash was not weakness. It was a reset. A mechanical purge in a market that had moved too far, too fast, layered with too much leverage. And resets in structurally tightening markets do not mark endings. They prepare the ground for the next phase. So when you look back at this moment, do not remember only the red candles. Remember what followed them. Remember the ounces that moved. Remember the spreads that widened. Remember the leverage that was erased. Remember the institutions that accumulated in silence. Because crashes expose structure. And this one exposed something very clear. The system still depends on paper. But power is migrating toward those who hold the metal. They are buying it all. And now you know why. This was never about a simple price drop. It was about exposure versus ownership. Leverage versus control, paper versus metal. The crash was loud, but the accumulation was quiet. The liquidation was visible, but the positioning was hidden. And when you strip away the noise, what remains is simple. Silver did not fail. Leverage failed. While many saw panic, others saw opportunity. While screens flashed red, vaults were being filled. While confidence shook, strategy hardened. That is the real reason for the silver crash. It was engineered by structure, accelerated by leverage, and seized upon by those who understand that in a tightening world, real assets are not speculation. They are insurance, leverage, and power. History does not remember the day traders were liquidated. It remembers who accumulated before the repricing became obvious. And by the time the crowd understands why this reset happened, the metal will already be sitting where it was always meant to sit, in strong hands, waiting for the next phase. They are buying it all. The only question left is whether you understand why.